Bill, have you boosted your GDP enthusiasm over the tax reform bill?
Well, a little bit, Tom, because you and I have talked a lot about the problem of productivity and why productivity is so low. And one of the things that people haven't talked a lot about in this tax reform bill is that we've really made some massive shifts in the incentives for investment. We reduced the incentive to take on debt. We increased the incentive to take on equity. Now you say, well, who cares about that? But, you know, one of the things that we care about a lot about Milken is capital structure, how you finance things, because financing gives you incentives. If you finance with a lot of debt, debt holders are subject to what the source of money, the guys who are giving you the money say, I want my money back. So you better invest in safe stuff and you better invest in tangible assets for me to get it back. That means that we have very incremental type investments. But the equity guys are saying, you know, if you invest in, if I'm a shareholder, I want you to swing for the fences. I want you to make those investments that increase productivity. That's where I think is missing, because you and I have both said we see technological progress everywhere except in the productivity numbers. Well, why is that? Because the quality of investment has not been boosting productivity. And I think this shift is going to help us get there.
I'll go with that, Bill Lee, but what you've been so good at over the years, and this harkens back to your work at the International Monetary Fund, is the distributive nature of those gains. It's a huge theme at the World Economic Forum. They want to do a lot of touchy-feely stuff on inequality. All of our viewers know that's not happening. When do we see trickle-down William Lee economics?
This is not trickle-down. This is trickle-up. We need to have real productivity gains so that the labor that's in the workforce can get higher income gains. And you're not going to get that if firms invest in incremental, old-style investments that just continue the processes the way they are. What you need is to have the technology really take hold, and that's not going to happen unless the equity owners really push the managers. Managers now are incentivized to just pay back money, and where's the money coming from? It's coming from debt. So you look at the private equity world, the returns are so high there only because they put in the management incentives to correct that.